Hi, this is TradingBTC.com, and we are providing our very first video here for YouTube, and hopefully we can do these videos, if not daily, at least every couple days, kind of give you a different perspective on things. And let me first explain that this isn't investment advice whatsoever. You need to do your own research and make your own decisions. What we're trying to do is just give you some other ideas to think about when it comes to the Bitcoin and cryptocurrency markets. So starting off here with this first video, I've got these two gray boxes, and going back into the June time frame, the shaded box is a measurement from the lowest price, June 24th, up to the 200-day moving average, which is this orange line. So we've got the 200-day moving average, we've got the 50-day moving average in blue, we've got the 20-day moving average in red. So the shaded area is the 200-day moving average down to the price, the lowest price of June 24th. And you can notice here that the shaded box will give you the amount of dollar amount decline in that period of time, dollar decline difference between the 200-day moving average and the lowest price. So in this case, it was 4,369 points, and percentage-wise, it was 43.51%. Now, the other box here is also taking the 200-day moving average, having the gray box go down to the lowest price here just recently on the 26th. And the measurement is 3144 in terms of points, and percentage-wise 47%. Now, the reason we take a look at this from this perspective is that the 200-day moving average is used as a sign of a long-term bull market and bear market. And the reason these gray boxes add value is because you can take a look and see from a percentage standpoint how far price dropped below the 200-day moving average. And when you take a look at it from a percentage standpoint, the lower the number is, or the higher the decline is from the 200-day moving average, in this case here, 43% back in June and 47% here just recently, is you can kind of think of this as a rubber band effect. The larger the decline away from the 200-day moving average, the farther the rubber band gets stretched. And when the rubber band gets to a point where it stretches so far it can't stretch any longer, then you get a snapback. And so now we're seeing the snapback starting. Now, I'm not going to make projections here, and the only thing I want you to consider is when you're in a bear market like we've been, and you're trying to determine when is a good time to start getting back in, you want to take a look to see how far price is away from the 200-day moving average. And you can use this on any of the other moving averages. But when you're at an extreme level, like we've seen this year to the downside, it'll work very well from a standpoint of reducing your risk when you're buying Bitcoin or any of the other cryptocurrencies, when they, in relative to their own price chart, meaning that you can go back and take a look at other time frames and see just how far price had moved away from the 200-day moving average to get a very good idea of how extreme prices moved away from the 200-day moving average, so that you have an idea of, okay, I think there's a lot less risk in the market right now, and now is a good time for me to enter. So it's very similar to the idea of a stochastic, where you're trying to measure how overbought, oversold the market is. It works from a standpoint of how you use an RSI. In this case, RSI got down into the looks like, let's just say 9-10 range. Obviously that's extremely oversold, but it doesn't necessarily give you the final price. As you can see here, even though we were down at 9 or 10 on the RSI, price still moved down. So I'm not suggesting that the RSI or stochastics are going to absolutely call a bottom, or even using this technique where you're measuring the distance away from the 200-day moving average. But it is just another tool that you can use to determine just how oversold a market becomes, and whether it's Bitcoin or any of the other cryptocurrencies or even in the stock market. Kind of take a look at this. You can apply this to any other cryptocurrency, get a measurement how far away from the 200-day moving average it is, and that'll kind of determine what your risk is of being involved in the market. It's also a way to manage your own emotions, because we know that when the market is in a bear market like it's been, and you're seeing your value go down, and let's say you're a hodler, you're not going to sell it anyway, but that doesn't mean that you feel like throwing up when you're seeing the market just completely get decimated. In this case, you can kind of take a look at this from a more logical standpoint and see how far away are we from the 200-day moving average, and go back and look historically how far away other bottoms have occurred relative to how far away to the downside the price is now. Hopefully I made sense when I explained that. I don't think I did, so let me kind of re-explain it. If you historically go back and see that 40% to the downside below the 200-day moving average, Bitcoin has bounced and bottomed. Well, then you can look at back in June and say, okay, it's 43.5% to the downside. I certainly don't want to sell anything here, but from my own standpoint, I know that, okay, we're getting to the extreme to the downside. And you feel a little bit better knowing that you're at the extreme to the downside. And then you look here in the recent downturn, and we're at 47% below the 200-day moving average. So again, there's been so much FUD that is out there that you get caught up in the FUD. And from an emotional standpoint, you're just seeing your coin values go down. But if you look at it from a standpoint of it's 47% to the downside, or prices below the 200-day moving average by 47%, then you can convince yourself that, look, it is ugly, but historically, we're going to get a bounce. And the bounce, the farther it has gone down below the 200-day moving average, the bigger the bounce is. So at least it's a way for you to manage your own emotions when you're looking at something from an extreme level. And we've certainly had an extreme move here with Bitcoin recently. So right now I think we'll cut it here, but we will do some follow-up videos on other cryptocurrencies as well, and then also discuss, once you're at that extreme, what is the most likely target to hit back to the upside when you're at an extreme. So again, this is our first video, so give us a little bit of slack. We'll get much better on these videos in the future. And definitely, if you like the video, definitely share it. Subscribe, click on the bell to get notified whenever we put videos up. And hopefully we can do these, if not daily, every couple days, and just give you kind of a different perspective on how to look at a chart and how to just manage yourself when it comes to trading and being a hodler here in the cryptocurrency space. So that's about it for now. I appreciate you watching the video, and if you have any questions, just leave it down below, and we will respond to you. Thanks very much. Have a great day.